Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Home Depot and do a stock analysis on Home Depot. But before we get into the stock analysis, of course, make sure to subscribe to my channel, Balance Sheets Matter. I do stock analysis videos, so if you want to get ideas on potential stocks to invest in or value traps to avoid, make sure to subscribe to my channel. Or if you just want to help understand financial statements of companies better overall, that's another reason to subscribe to the channel as well. Make sure, of course, to like the video. And if you do want me to look at a stock, leave it in the comments below because I frequently do get subscriber requests. A lot of the recent videos I did were subscriber requests. But with that, let's start getting into the stock analysis. But there's one more thing I quickly want to mention is that Home Depot has recently announced that they've closed a big acquisition. It's almost an $18 billion acquisition and of SRS distribution. And this is really not factored into what the analyst estimates we're going to be looking at and the financials. So I'm going to be kind of weaving that in and how that's going to be affecting things going forward in the future, because due to the large size of it, it does shift things a little bit more than normal. But with that, let's start looking at some of these top level metrics. You can see, first of all, the P ratio is sitting at 24.37. We're going to see if this is a little bit high or a little bit low. And with a forward PE of 24.04, but remember, this is based off these analyst estimates that have not basically factored in this acquisition they've done. So it actually might be a little bit lower in the future. We can also see the Group Focus Value Band here. This is kind of their own little estimate of fair value. Sometimes for predictable companies, it can be a little bit accurate. It's saying it potentially could be a little bit overvalued. We're going to see how accurate that is, though. Other important thing is people who like those dividends and those dividend investors, basically they have about a 2.3% dividend yield with a very reasonable payout ratio of 0.55. And they also have a very nice dividend growth rate of 11.7%. So even though the dividend yield's low, they do basically grow that dividend over time because the forward dividend's looking 2.42%. So let's dive into the financials now and start covering a little bit more. So first, we can see just a little bit of the history of their growth here. The green line on the right is basically their long-term revenue trend. And while we can see that in the last 10 years, their growth rate per share was 11.6%. An important thing to factor in for this was kind of measuring after the great financial crisis, the 2009 recession there. So it's kind of cherry picking a very good point for looking at the revenue trend of Home Depot, because Home Depot, if you are aware of the stock, it basically for the last 10 plus years has had about a 20% compound annual growth rate. So they've got that because it's a little bit of a cherry pick act, like a cherry picking spot there, because they used to have higher revenues in 2007. They dropped down, and then when they kind of recover those, that's a benefit for them as well. Their EPS has outpaced the revenue growth, and we're going to be going through the financials and seeing if that is realistic, if that's going to happen in the future, or what is actually going to be happening, because their EPS growth was 16.4%. So to achieve that 20% compounded annual growth rate, they were getting a little bit of multiple expansion along with basically EPS outpacing their revenue. So let's start going down into some of the financials. One thing to look at that some people like to know is the return on invested capital. So Home Depot for the last just under 10 years has had a very, very strong return on invested capital of basically around 30%, which is much higher than their weighted average cost of capital of basically just under 10%. And this starts becoming relevant because basically when they do invest in the business or do acquisitions, they typically can get higher returns than what the money costs them. And with this acquisition, they are going to be taking on $12.5 billion of debt. So this is an important thing to consider. So what this is telling me is that Home Depot can easily take on at least this debt, and they are going to be able to get a return on it. That is, they're going to be able to get a return on the debt if they take it on. So now we look at the income statement. You can see from 2009 to 2010, there was that revenue decrease, but then it's been up and away since. Although since 2023, there has been a little bit of a pullback. But with the acquisition they're doing, it's costing them $18 billion, and SRS distribution does about $10 billion a year, and they have been growing. So we should see a short-term pop basically in their revenue growth. And this is also what we saw from an acquisition back in 2020 to 2021, because you can see there's this big jump of $22 billion here of revenue. And that was because they did do another large acquisition, not as big as this one, but that is significant. And you do have to consider in that they can only do so many acquisitions. There's only so many strategic opportunities to grow. So when we're seeing this 11.6% revenue growth, this is because they have done some acquisitions along the way, and probably the underlying growth of their fundamental just core business is not going to be able to go forward at that speed. But one nice thing about Home Depot is its gross margin does maintain at 33-34%, which pretty much means they're kind of maintaining their competitive moat. They're not gaining on it, they're not losing it, but this is extremely good and extremely stable, which is nice to see. Another interesting thing about Home Depot is the operating margin has been growing quite significantly over the last 10 plus years. It's not showing basically further back in 2009. I could bring up those, but really all you need to know is it was probably usually around 9-10%. They had a little decrease into 2009, but because of that, basically that operating margin just increasing on this trend here, that's helped raise their EPS, which is one of the reasons basically why we're seeing that 16% EPS growth outpacing that revenue trend. But you can see from 2017, it starts plateauing around 14%, maybe a little bit higher, got up to 14 and or got up to 15, and now it's pulled back to 14. And this is actually an interesting thing to know, like that says about kind of a retail store like Home Depot, is typically retail stores have a lot of problems when they're growing and they really start struggling, as I've gone over a lot of struggling retail stores before, and the warning signs in them is basically they'll be either losing on their gross margin or they're going to be losing on their efficiencies because they're just opening a lot more stores, and in your stores you're going to have more and more basically people there and selling in general admin. But what this is telling me is Home Depot's actually being able to get more efficient with their selling and general admin because their operating margins have been going up and not down, which is a very good sign, basically showing that they're not late in their growth cycle. So this is a good sign for Home Depot. I'll also just go and just quickly show the store count. They really have not grown their stores at all very significantly, and this doesn't seem to be anything they wouldn't be happening in the future since it hasn't happened in the last 10 years. As we can see here, they've only grown 100 stores in effectively 12 years here. So the store count stays very stable, but they basically are able to keep their stores operating more and more efficiently as time's passing. But I really doubt at this point, since this has been basically plateaued for so many years, they're going to be able to increase this operating much more. So what we're going to be wanting to look at Home Depot is just for them to hopefully at least maintain this, which is going to mean that their EPS growth is going to start dropping down in line with the revenue growth there, which is kind of one of these things that can slow down Home Depot. The next thing I like to look at is the interest expense. Basically, the interest expense has gone up a fair bit. It's at 1.9 billion, almost $2 billion, but this is quite affordable for them since they do have over $21 billion of operating income, even though that's a drop from 24 billion. I usually like to see about a 1-to-10 ratio for basically your operating income over like the interest expense, because that just makes it very easy for them to service. So they're in a very good spot there. So that's a good sign for Home Depot, but they are going to be taking on $12.5 billion more of debt for this acquisition. So we will be seeing this interest expense rise up in the next basically couple years. And maybe that's why the stock, when it basically opened on Monday, was down 4%. Maybe the market is not so happy with the new debt that Home Depot is going to be taking on the acquisition. A lot of the time, if you've been around the stock market for a while, when large companies do large acquisitions, a lot of the time the stocks drop in the short term for a little bit until they really see how those synergies and that effectiveness really turn out for the stock. One thing I don't always cover, but I think is actually relevant to Home Depot and what's really also fueled their EPS growth is the tax rate. As we know, there was those basically corporate tax cuts in 2019. So we did go from about 36 to 37% tax rate down to about a 23 to 24% tax rate. And you can basically see this also is kind of right when their operating margins started plateauing. So that's really helped fuel their net margin and that EPS growth, because they're getting this accelerated margin basically from growing their margins here faster than their revenue, and then right when this starts plateauing, then the tax rates drop as well, which gives it that extra boost as well. So kind of Home Depot's had multiple factors that have really helped drive their EPS growth in the past, but it's really unrealistic that we're going to be seeing any drops in tax rates in the future. And as I already mentioned, the operating margins are also going to be difficult to grow as well. So that is kind of just leaning towards this deceleration EPS growth. And this is all reflected basically in the bottom line here of their net margin. You can see back in 2009, 3%, and it was just growing every year, almost like 0.5% to 1% per year, up to about 10%, getting close to 11. It's pulled down to 10, but it's really this net margin growth that's really rocketed this EPS growth as well. So this is really good that they've been able to do this, and probably is one of the reasons why they were able to compound at this 20% compounded annual growth rate in the last 10 years. But they're really going to struggle going down in the future, since most analyst estimates are kind of saying they're going to grow at a much slower pace, as we'll see a little bit further down. Another big factor was basically they're buying back shares as well, because they are a very well run, very profitable company. You can see they have massively decreased their shares. So they've gone from, over 1.5 billion shares down to basically under a billion in effectively a decade, which is also helping that fuel that EPS growth. So that's kind of the triple trifecta of, the shares going down, the tax rate going down, and your operating margins going up. And I don't think that we're going to go a little bit further, that we shouldn't be expecting all of those to happen in the future for a variety of reasons. So let's look at their balance sheet quickly here. I think it's sitting on about just under $30 billion of current assets, and current liabilities only $22 billion. So it's a good current ratio. Other thing that was just keep in mind, but that's not super relevant, is like a lot of different basically retailers and companies, they really stocked up too heavy from the supply chain issues in 2021 to 2022, and then they got stuck with a little bit too much inventories maybe, but they have been getting that under control, so that doesn't really seem to be an issue going forward, but it was an issue for a lot of other companies. And basically we can see total assets here sitting at $76 billion. We do have to keep in mind almost $8.5 billion of that is goodwill, because goodwill is just kind of added on because of the acquisitions, and I usually like to subtract this out from their equity at the end to kind of get a better idea of where they're sitting at. And we go down and we see this in comparison to the liabilities. Well, their total liabilities are $75 billion, because they do have a fair amount of long-term liabilities of almost $43 billion. You can see back from when they did the acquisition in 21 to 22, they basically took on some more debt, and since then they've even taken on some more debt. And now we know they're going to be taking on $12.5 billion more debt. And this is one significant thing about this acquisition, is that Home Depot is taking on a lot more debt, and that is putting their balance sheet in not necessarily the best place. And I don't think the market, the street as it's called, necessarily is going to like that, because they have about $1 billion of total equity. We take out that goodwill, that's going to be basically taking out 8.5 billion. So they're already negative over $7 billion of total equity. And I'm not sure exactly how much goodwill this recent acquisition is going to basically add on, but we could expect some more $1 billion there. So while their short-term part of their balance sheet is, quite healthy, they can afford their bills, they are stacking up that debt right now, which kind of gets in also when we get into the cash flow here, which is going to become relevant relating to the share buybacks. But before we get into that, the one thing I like to look at is basically we're going to look at the cash flow from operations and see the cash flow from depreciation and the purchase of plant, property, and equipment. And the reason why I showed the store count before, because they really aren't growing their stores when they actually are just at replacement value, as we can see basically going through, the last 10 years, typically however much they're depreciating, they're rebuying, they're at the replacement value, which is a good sign that whatever like assets we do see on their balance sheet are kind of real. Because a lot of times you'll see companies that they'll be depreciating maybe $2 billion, but they're going to be purchasing twice or three times as much of that. And if they have a big balance sheet showing a lot of equity, then that would mean that's really not the case. But we can see that Home Depot, their stores are fairly flat, they're like not increasing very much, and they're just purchasing at replacement value. So that kind of says what we're seeing on the balance sheet is fairly accurate. And you can see they do these acquisitions over time. They've had a lot of little ones. They had this one big one in 2021 here, which is why there was such the big revenue jump. And now we're going to be seeing another one as well. And now it really gets into the next part of the repurchase of stock. You can see Home Depot has really been repurchasing a lot of stock in the past. It's a good way of returning capital to shareholders. And also they pay that nice dividend as well. And the one thing I kind of like about Home Depot is they split these up quite nicely. I find sometimes companies just repurchase stock, and that kind of ends up meaning they just buy high all the time, because when times are good, it's easy to buy back a lot of stock. But you go back to 2009, 2010 here, they kind of stopped their share buybacks. So when the stock's the lowest, they're not buying back the shares. And that's also one of the reasons why the stock can go down further, because you don't have this extra support of buying. But because they're still paying the dividends, even though you weren't getting those repurchase of shares, you're still getting that capital return to the shareholders, and you're not just buying stock high all the time, which tends to happen a little bit with stocks that only do repurchase of shares. But the thing is, with all this debt they're taking, Home Depot has announced in this release here, we can go down a little bit there, that they basically more or less are planning on pausing their share buybacks for the next 2 years. So, and repay their debt, which is a smart thing to do because they want to get those basically the debt ratios lower. It is a little bit too high, but that means this repurchase of like shares, like repurchase of stock that's been happening, that's been helping raise the EPS and has been actually helping elevate the stock price as well, is not going to be there anymore. So that is some potential downside on the stock just because of that. You don't have those inflows from Home Depot themselves doing that. But regardless of all of that, even considering that, they do have very good free cash flow from operations. They can easily afford the dividends. So I would not expect dividend cuts at all from them. Obviously, they continue on raising it, but they're going to more or less be taking this repurchase of stock and they're going to be using that for or using that to basically pay off their debt instead that they're going to be taking. So that's a good thing to do, but could mean some temporary weakness in the stock. And with that, now let's get into the basically what I like, the interactive chart here. Look at the relative analysis. So let's just pop up the revenue with estimate and the EPS with estimate. And this just gives you an idea what analysts are expecting, but this is without this acquisition they've done, because you can see here, basically, they're expecting the revenue just to be creeping up, a little bit each year, maybe in that 6-7% range or so. And they're expecting the EPS to outpace that. But this is going to be a little bit different with this acquisition, because what's going to happen is we're going to see a big jump in the revenue. And without those share buybacks, we're not going to be seeing the big jump in the EPS. So that is going to shake up things a little bit. But the acquisition is going to basically, hopefully, if they find some synergies with it and can, find some extra value than it just is, it's going to help unlock some more revenue growth. But even regardless, at their size, they're going to really struggle kind of actually growing probably above 10%, which is why we're going to probably see maybe that 6-7% revenue growth in the future, which is quite a bit different than what they've been in the past. Let's take a look at the price to sales ratio. This kind of gives into the relative analysis if it's cheap or not. Go on a little bit shorter time frame. And you can see when the margins were lower back here, it did tend to be a little bit lower. So even though it's higher, that's not the biggest concern. So now that we know kind of probably these net margins are going to maintain at this higher level, we can look at this past history and kind of see how it is. And you can see right now, back when basically the Home Depot, the price stock was low and the price to sales ratio was low, that was a good time to buy. And right now, it's a little bit on the pricier side. I would say Home Depot is a little bit maybe overvalued here. It's not a place I would necessarily be wanting to buy it. Also, these ratios here are kind of based, this like price to sales ratio and valuation is a little bit based off those previous growth rates too, which may probably and may not continue in the future. So there is a potential that we could see in the longer term future a little bit of multiple compression for Home Depot. But if I was looking to buy, I would probably be waiting for the price to sales ratio to get at least back down to these previous levels they were at before. Now let's also look at the P/E ratio, because they have been a very consistent, profitable company. The P/E ratio is also one of these metrics that is very accurate as well. And we can kind of see that same story playing out. The P/E ratio is a little bit high, and typically when the P/E ratio is high, stock price is a little bit high, and it's not been a great time to buy. And when it's low, it's been a good time to buy as well. But if we go a little bit further in the past, you will see that there was a lot of times, especially basically kind of from 2003 into after 2009, where the P ratio was quite a bit lower than it was today. So that is one thing you kind of have to watch out with Home Depot, is if they aren't going to be continuing those previous growth trends, it may mean there could be a little bit of multiple compression for them in the future. But they are a fairly high quality company, so I really wouldn't be too worried about that. I'm just personally would be a little bit picky basically about buying the stock, really waiting it to get down to at least the lower range of what these, basically 2010 post P ratios were before getting interest in the stock, because what could happen is it always could go a little bit lower with these kind of factors we have in. And also let's look at the dividend yield. Dividend yield basically also kind of this relative analysis can tell you a little bit about that too. And you can basically see when the dividend yield was high, it's a good time to buy, and when it was, low, it's expensive. Right now, it's, kind of a midpoint here. So again, speaking, that's not too interesting of a stock. And if we do go further back, well, we can see that there was times it was a lot higher before. And frankly, with the payout ratio they have, a 2.2% dividend isn't super high. So this is, again, just kind of a little bit of my bias and my analysis that I think Home Depot's a little bit pricey right now. So we can look at basically the stock chart here, do a little bit of technical analysis, combine this with the fundamentals. You can see now that basically they did the announcement of this acquisition. I think it was after market close at the end of last week. So now that it's open, it's gone down 4% and could potentially go a little bit lower. So I'm just going to open this up into a little bit longer term trend. And you can see this channel here is not actually something I believe it will continue in, because this channel here is that 20% compounded annual growth rate. And for this to continue, you have to believe that Home Depot is going to have some significant margin expansion. Otherwise, it could maybe start trending sideways, but these lines here, are potentially just technical points to do. I would personally probably waiting for the lower trend here. Probably not going to get that, but also it may just drop to the low 300s and could be a potentially good buy there if you feel that there's going to be some narrative of basically Home Depot keeping a little bit for those higher multiples. But if the multiples would be compressing, I would be looking kind of more for that under 300 range, 290 to 275 before getting into Home Depot, because I very highly doubt from just their fundamentals that this 20% compound annual growth rate is going to be able to maintain forever. Maybe for the short term it could if you're a momentum trader, but for the long term, I think the financials show that it's very unrealistic of this to happen, and they're going to have to lose this trend and find a little bit of a slower trend going forward in the future. So anyways, I hope you like that stock analysis. I hope it gave you a little bit of insights. Make sure to subscribe to the channel, like the video, and if you do want me to look at the stock, leave it in the comments below, and I'll see you in the next stock analysis.